Okay, we'll kick off this morning. A very warm welcome to everyone to this webinar hosted today by Brook Green Supply. My name is Mark Westwood, and for anybody that doesn't know Brook Green Supply, we are a traditional energy supply company offering an array of solutions. So everything from REGO-backed electricity supply agreements to green certificates, whole load of trading strategies and products, but also now looking beyond supply. So looking at some of the ancillary services, capacity markets, demand side response, and some of the big buzzwords out there at this moment in time, corporate power purchase agreements, a lot of EV solutions, as well as a lot of in-house tech. So today's session, again, my name is Mark Westwood. I head of direct sales. Expect this webinar to be around 45 minutes. We'll make sure that there's time at the end of the webinar to complete some questions and answers. If anybody does have any questions, if you go to the bottom of Zoom, you can actually see a Q&A function where you can post your questions there. And we'll try and answer as many of those as live as possible. If not, we'll get back to you after the session. So today, speakers are Lewis Harrison and Alexis Rigas. Lewis is one of our gas and power traders, and as you can see, a few of the agenda items that Lewis will look to cover, and similarly with Alexis, sessions on non-commodities and some regulatory updates. If anyone does have any questions, again, please do post them in the Q&A posting session within Zoom, and again, we'll try and answer as many of those as possible in this session. So let's kick off. Lewis, over to you.
Cool. Morning, everyone. So in the market update portion of this webinar, we're going to be covering a bit of price development on a month ahead basis, some price action on a day ahead basis, some actual UK temperatures, a 45-day UK temperature forecast, a couple of slides on storage levels, both where we currently are and a bit of a forecast with regards to the lack of Russian flows that we may see. A slide on LNG pricing, Trump's impact, fund positioning, and then a bit of an outlook at the end. Cool. So over the summer 24 period, we've seen largely bullish pricing, and that may have come as a bit of a surprise to some people, considering how we entered this summer 24. After a mild winter, high storage levels, we've seen a number of factors, including some geopolitical risk, increased length in fund positioning, and some supply outages at play that have all contributed to this significant price increase over the summer 24 period and leaking into winter 24 as well. On a day ahead, on a more prompt basis, we've seen some cheap power pricing at the back end of September and the start of October. This is namely down to increased renewable generation over those periods. And you can see quite a large disconnect in pricing there, the blue line being UK power and the green line being gas. And I think this is going to be a common theme moving forward. It may not become as prevalent in the winter, but certainly over next summer, the disconnects between power and gas pricing purely down to increased renewable generation is going to become far more prevalent. We can move on. Cool. So temperatures. I think, again, as I went through on the previous slide, mild temperatures did contribute to that muted demand and that cheap power and gas pricing. And I think probably the most significant portion of this graph is the temperatures that we've recently seen, it being very cold over that week of the 18th to the 24th of November. And it's worth saying there that the power system especially dealt with that cold snap very comfortably. We didn't see too high pricing on SIP or EPEX, SIP being a system imbalance price. And typically in really cold periods, the disconnect between EPEX and SIP can be quite large if the system gets incredibly tight. But EPEX over that period only averaged just over £90, with SIP at a discount to that £90 over that 18th to 24th of November period. But it is worth mentioning as well, these cool temperatures were experienced across the whole of Europe, which off the back of that, we saw pretty significant drawdowns on storage, which I'll go into more detail of later. Cool. 45-day weather run. As is typical with this 45-day forecast, it typically oscillates around seasonal norms. And what you see, especially in the winter periods, because demand is far more sensitive to change in weather runs, the open of the European markets become incredibly sensitive to current run compared to previous run, i.e., weather looks warmer over this back end of December and start of Jan, prices will likely come off on the open. And I think the key portion of this weather run for December is going to be that back end portion, just because this year, fortunately, we've got an almost extended holiday period, and off the back of that, demand will be reduced, and any kind of increases or reductions in temperature, especially on the power side, may see pricing more so on the downside affected significantly. LNG pricing, pretty hot topic at the moment. So recently we saw the JKM and TTF pricing relationship flip. So the JKM is the Asian bid for LNG. The TTF serves as a European bid indicator. And for almost the whole of summer, the TTF bid has been at a discount to the Asian bid, partially due to warmer than normal climates over the course of summer in Asia. But off the back of this relationship flipping, we saw at least 11 cargoes rerouted from Asia to Europe. So keeping an eye on this is going to become incredibly prevalent over this winter and next summer, when inbound LNG is is becoming incredibly important when it comes to injecting into our storages. And to add on from this as well, we're even seeing a decent sized bid from North African countries, Egypt lifting 40 cargoes. So again, this just adds to the competitiveness of the LNG market. And it's also worth mentioning that this now needs to be globally considered. We're not solely in a European gas market now. This Egypt taking cargoes away from Europe affects the global balance. So the competition for LNG is going to be incredibly important over this winter and summer. EU storages. I think main two takeaways from this are probably going to be that we've just dropped down below the 5-year average, and you can see the steepness of those drawdowns that we saw over the course of that cold week in November, and the shallowness of the gradient on the way up through summer, and that was down again to the lack of LNG supply we had in Europe. Some storage forecasting. So what we have is a best case scenario, a 5-year average scenario, and a worst case scenario. And it's looking likely that the 40 MCM from Russia that we get delivered through the Sudza entry point is looking like at the end of this year that's going to terminate. And although 0.05 of increase of storage drawdowns may not seem significant, when you factor in that over a 180-day period, that does become pretty significant. And you can see that with even the 5-year average scenario and the worst case scenario there as well. Also, the market, I think, has little hope of those flows continuing, as any news headline you see surrounding the promise of that gas continuing to be delivered through Ukraine, a steep sell-off is usually follows. And I think the pricing action we've seen over the course of the last 3 months, the Q1 and summer 25 have been far more sensitive to price increase than the winter 25, and that's purely down to storage. That is an indicator of how important it's going to be over that Q1 to continue getting LNG supply into Europe, and that summer 25 injection period where it's essential that our bid remains competitive against our Asian competition. Cool. A bit of Trump impact. So the graph on the left shows the 6th of November. So that was the day after Trump was essentially elected into presidency. And you can see there, so a significant morning sell-off upon the European Open. And I think this is mainly down to the overarching theme of Trump, being fundamentally fundamentally happy to build out the oil and gas infrastructure. He's very pro LNG, he's very pro oil. And the main kind of point there, I think, will be to lift Biden's ban on new LNG exports, which are listed in the bullet point below. But this infrastructure increase is likely to not affect us until 2027. So the backwardation in the curve could increase, i.e. contracts further in the future are likely to be more discounted to contracts nearer term. And then you can see, on the open of the US markets, you can see a pretty significant rally. And this wasn't only experienced in gas, this was also seen in oil, in dollar strength, in US stocks. So I think that's a macro-driven move of bullish US market participants lifting the commodity complex. Fund positioning. This is something that's become more and more prevalent over the course of summer. And you can see on the graph on the left how correlated the fund's length, i.e. how long funds are, correlate with TTF pricing. So you can see the longer the funds get, the higher the price gets. And it's worth noting that funds are at a current 5-year high of net long position. But a few questions can be asked off the back of this, I think. Is the market more sensitive to downward movement pricing due to fund unwind? So yes, essentially, if you see a sharp decrease in pricing and funds are long, they're going to have to stop out of that length and then add to what will likely be bearish downward price momentum off the back of the initial sell-off. Where is the length being held? I think, again, this is prevalent because is it just an overinflation of short-term contracts, or is this length leaking out into contracts further along the curve? And who is behind this fund length? Is it CTAs? Is it more smart money? CTAs being a more systematically driven funds, or smart money people taking kind of proprietary positions on this stuff in massive size? Cool. And a few market considerations. So as I mentioned before, you've got the lack of Russian flow via Ukraine, which served as 6.5% of the EU supply stack over October 24. The LNG pricing relationship between TTF and JKM is going to be really important over the course of this winter and summer to allow us to inject enough into storage. Weather, which is always a consideration over winter, long periods of cold weather may see us drift down towards that worst case scenario of 7.5% storage by the end of winter. Fund positioning unwind, if that happens, I mean, it will show where they have length, and choppiness in the market and sharp movements on the downside may see kind of more aggressive price movements downwards. And the summer 25, winter 25 spread. I mentioned that the Q1 and the summer 25 have really blown up compared to the winter 25, with summer being at a premium to winter. And I think, again, a lack of injections over that summer 25 period could cause a decent amount of upside price movement on that winter 25 contract. Cool, and that's me done, so I will pass over to Alexis.
Thank you, Lewis. Morning, all. So today I wanted to cover a lot of the significant changes to the non-commodity costs that we've seen recently, with more on the horizon in the form of regularity updates and new levies. Now, while I can discuss all these changes in detail for hours, I've worked to summarize the key updates in the slide deck we'll be reviewing today. So the main goal of the webinar today is to provide an overview on regularity updates for power and gas, as well as highlight the major changes that we can expect from October onwards in our non-commodity cost stack for winter 24. So before we do go into the content, I do want to encourage everyone attending today to let me know if there's anything specific that I haven't covered, or if you'd like any further clarifications on any of the topics that we're talking about today. Please feel free to reach out to me directly or speak to your account manager, and I'd be happy to arrange a call on this or answer any questions via email. Moving into the first slide. So the first slide that I wanted to talk about is the energy intensive industries. So the energy industry supercharger mainly consists of three components. So the first component is the increased discount for environmental levies. So this is kind of like a reminder because this went live in April 24, but essentially this discount increased the maximum discount all EII customers can get from 85% to 100% for environmental levies such as renewable obligation, contracts for difference, and feed-in tariff. The second component of the energy industry supercharger is the 100% indirect exemption for capacity market. So this has now gone live since October 24, and all EII customers will be 100% fully indirect from all capacity market charges. Now, the third component is the Network Cost Compensation Scheme, so the EII Support Levy. Now, this is a new levy that's being introduced, and basically the scheme provides a 60% discount on all network costs. These costs include the balancing service use of system, the transmission network use of system, and the distribution use of system. While this scheme officially started in April 24, it's key to understand that all EII customers will continue covering these costs initially, and compensation payments will begin in April 25, where Elexon will redistribute these funds back to these EII consumers. In regards to costs, while this is still indicative, our forecast for how much this rate will cost in a pence per kilowatt hour rate for the first quarter is approximately 0.13 pence per kilowatt hour. Moving on to the second slide is I wanted to talk about the nuclear levy. So the nuclear levy is basically a funding model that's been selected to deliver Sizewell C, the nuclear power, which is the nuclear power station, and it's also going to be used for any future nuclear projects. Now, this model essentially is employed to deliver major infrastructure projects such as Thames Tideway Tunnel in the water industry, and also was used for Heathrow's Terminal 5. The RAB model is basically the same, will work the same as the contracts for difference mechanism, but the key difference here is that it allows developers to receive revenue during the construction phase of the project. Under this model, the nuclear plant developers will be funded by all licensed electricity suppliers to cover and design the construction phases of the nuclear project. This kind of means that suppliers essentially will bear the entire allowed revenue as set by Ofgem until the plant actually begins generating electricity. Now, I also do want to mention with this scheme as well, it will be administered by the low carbon contracts company, like the CFD scheme, and this nuclear levy will include an interim levy rate, mutualization mechanisms, and also an operational cost levy. Now, in terms of time-wise as to when this cost will come into effect, it kind of also depends on a commercial contract that needs to be finalized between Sizewell C and the government. However, what we're hearing is it will probably come into effect as early as Q2 25. So that would be early July 25 or latest Q1 24. So that would be April 26. Moving on to BSUOS now. So BSUOS basically is a cost to cover the day-to-day operations of the transmission system from generators and suppliers. Now, this charge depends on the balancing actions taken by National Grid every day. Now, with this, NESO have approved that this change to BSUOS, essentially they've moved from this being a variable charge to now being a fixed charge. This initial change was raised in December 22 through CMP 361, which basically meant that instead of it being a variable charge, industry would give suppliers a 9-month notice for a fixed tariff that would take effect for 6 months. However, since January 23, NESO have now proposed a new mod, which is called CMP 408, which essentially reduces the notice period for BSUOS tariffs from 9 months to 3 months. Now, this proposal essentially is designed to improve the accuracy of BSUOS costs and forecasts and minimize the risk of mid-period tariff resets. Now, up to now, we haven't had any mid-tariff resets. However, I think with CMP 408, the idea is that they would eliminate the risk of this ever happening. CMP 408 also aims to reduce price risk to suppliers and consumers, because also you're getting to a point where they're still giving you that notice period for this tariff, but they're still giving you a tariff that's fixed for a 12-month period. Now, I do want to cover with this that although this change is officially now live and will take effect from April 25, given that industry have already published tariffs for next year, so April 25 all the way through to March 26. So they've already published these two tariffs. These two tariffs will still exist. However, in April 26, we will get a tariff which will be applicable for the full 12-month period. What I wanted to highlight on this graph here is basically the volatility, initially the volatility that you see with BSUOS. So the blue line basically is the average monthly BSUOS rate, and you can see how volatile it is. So I remember a time with BSUOS as well where it could range anywhere from negative pricing all the way to its peak at approximately £136 per megawatt hour. Hence why CMP 308 was introduced with a fixed tariff. Now, what you can see here is the orange line, which is the fixed tariff. And you can see during the first year, so from April 23 to March 24, you had quite a big over recovery. Now, this over recovery now fed into the next tariff, which kind of meant that industry during that year under recovered. So you're kind of getting this fluctuation in terms of pricing, where you have, for one period, you have a really high price, which in this case for summer 23 would have been £13 a megawatt hour. You get into the next period where that over recovery feeds into that next period, and then from April 24 you get a tariff which is about £7 which was about £7 a megawatt hour. Moving into the next tariff, where because you under recovered, that's jumped up again, so it's about £10 a megawatt hour now. So the whole idea of CMP 408 is to kind of eliminate this constant jump from having one high tariff to one low tariff and having these vast over and under recoveries when these tariffs are active. I'd also like to cover the hydrogen levy for gas. So support for the new hydrogen projects is also being currently centrally funded, and this is going to be moved to a levy likely in 2026. However, this is not really confirmed yet. Like the nuclear levy, the LCCC are going to be the administrators of the scheme, and they're working with DESNZ on this implementation. It will be a volumetric levy on gas suppliers, and there's also potential with this that the equivalent of EII customers or EII discounts for power will be replicated for gas. Onto carbon capture and storage levies. So the government was also going to support the rollout of carbon capture and storage technology. There's not much information on this yet. it kind of also depends on the success of the rollout, but we do anticipate that this will come through at some point, likely some point April 27. But I think it's worth also keeping on everyone's radar as well, because I do feel like it will come to effect. It's just time-wise now. With this, alongside the hydrogen levy, we will continue to closely monitor these two levies. And once we start to know more and we get relevant updates on these levies, and once these are available, we will be reaching out and updating everyone on the progress of these levies and when you can expect them to start coming, going live, and also in terms of what we can expect they would look like cost-wise. To cover the changes that you will see from October, or winter 24, we've got, like we mentioned in the previous slide for Basuos, is we've got the summer tariffs now and we've got the winter tariffs, which essentially is a forecast, but this will be finalized in the next few months. So like I was saying before, so you had the point where they started to introduce this tariff and you had really high tariffs at the start. You have a lower tariff for summer 24, and then summer 25, because of that under recovery, you have a higher tariff. So the tariff now is 1.074 pence per kilowatt hour. So this will be applicable from April to September, and the tariff you'll see now from October to March is 1.217 pence per kilowatt hour. And the whole point of CMP 408 is to come in and try aid this so that you don't have such jumps in terms of the tariffs and you don't have such big over and under recoveries. Onto capacity market. So capacity market, the price is derived by the two auctions. So you have the T1 auction and you have the T4 auction. So the T1 auction is held every year, and basically the idea is that it will cover any shortfalls from the T4 auctions. The T4 auction is every 4 years, and it's basically to secure long-term capacity for long-term planning. Hence, once the T1 auction comes in, this will cover any shortfalls that wasn't taken into consideration when that T4 auction went. Now, what I wanted to show with this is basically we're seeing quite substantial increases in the capacity market rate. It's mainly driven by the T4 auction results. So we were seeing very, very record high clearing prices for the T4 auction results. And basically, so we get an understanding. So the clearing price in capacity market kind of refers to the prices at which capacity agreements are secured during a capacity auction. It kind of represents the amount that generators and other capacity providers will be paid per kilowatt hour, or megawatt for the capacity they commit to provide it when they're called upon for the scheme. This slide kind of shows our forecast of what we think the capacity market will look like entering now into the capacity market year. So remember, like, the capacity market year is very different in terms of the year that it's active in terms of the other non-commodities for power. So it's active between October to September. So delivery year 24, you can see 14.061 pence per kilowatt hour on peak demand is our forecast going into this capacity market year. You can also see I've given you what I think approximately the rate will look like for delivery year 25. However, this is still indicative because, as we saw in the slide before, the T1 auction hasn't taken effect as well. So once the T1 auction goes live or finishes, then we have a better view of what this rate will look like for that delivery year. But this is kind of gives you a good approximation on what's happening. And you can also kind of see like the increase in terms of prices, where you had a much lower prices in 2022 compared to delivery year 2025. We've also given you the full demand pence per kilowatt hour rate. So instead of you trying to forecast what your consumption would look like during those peak periods that it's applicable, because remember, the capacity market is applicable to weekdays between 4 to 7 from November to February. You've also manipulated that rate into a full demand rate. So you can apply that on full demand so you can get a view of what your cost would look like during the year. FIT and CFD. So FIT is basically a government mandated charge to cover small-scale renewable generators, and generators receive a payment for generating electricity and exporting electricity. So it's mainly solar based. So that's why you see all this fluctuation between different periods. So you'll see higher prices during the summer and lower prices during the winter. Now, what I wanted to mention with FIT is it's not as volatile as CFD. So CFD is probably the most volatile cost we have on, well, in the non-commodity cost stack, and it's probably the most important as well, given how heavily linked it is to the market. I've also provided you for the next year, approximately as it stands today, what our forecast for these two costs are. But it is worth noting that CFD is becoming really, really important, and I do want to stress that because other costs like FIT and RO, you're basically getting to a point now where you're managing the decline of these costs. So these costs are essentially coming towards an end. Hence why with RO, there's talk that a fixed price model might come into effect as well. There's not much information on this, but once we get a lot more information on this, we will relay this to you. But it's kind of about managing the decline of those two schemes. However, as CFD is meant to replace RO, CFD prices and CFD in terms of forecasting CFD, is just going to get more important as the years go on. To cover a bit on gas as well, as we enter into the new gas year, we've got updates on UIG. So UIG is basically when gas is transported around the UK, some of that gas is lost. That's due to unregistered meters, pipe leaks, theft, and so on. So these costs kind of have to be recovered, and these costs are recovered through charges to gas users. How this is recovered is an independent expert will decide and implement a methodology that fairly apportions UIG weighting factors across each settlement class and EUC. In this gas year, we've seen a decrease in the total UIG quantified. So we've seen a decrease where it's come down from 8,497 gigawatt hours to 7,761 gigawatt hours. We've also seen a decrease in the aggregated AQ, so annual quantity shared amongst the EUC bands, which inevitably, because of these two, what we're going to see is a slight decrease in UIG rates moving forward for this gas year. On to general non-transmission service charges. So these are your NTS charges, and these kind of charges relate to the cost incurred by the operator in managing the flow of gas at exit points where gas is delivered to shippers, local distribution networks, or end users. What I wanted to cover here is mainly that in this new gas year, we've seen quite a big decrease in the rate. So last gas year, it was 0.053 pence per kilowatt hour. However, the new rate you'll be seeing applicable for this gas year is 0.0075 pence per kilowatt hour. On this slide here, kind of what I wanted to show is essentially the split between commodity and non-commodity for gas and power. So you can see the approximate split currently between gas is 80% commodity, 20% non-commodity. For power, you've got a lot more in the non-commodity. So currently it's about 65-35. Now, what I wanted to cover here is basically that the cost of electricity the cost for the non-commodities on electricity is a lot more than gas. So the UK government, there's been rumor from the UK government that they're working on rebalancing the energy policy costs for the transition to a net zero energy system, where the concern is the most vulnerable members of society may be disproportionately impacted. So what they're kind of saying is that there's potential that they might shift some costs from the power non-commodity cost stack onto the gas non-commodity cost stack. There's not much that's been released about this. However, we are seeing this come up. And once we do get a lot more information on this, we'll definitely relay this to yourselves so that we can keep you guys updated on any progress that this might make. Onto our reconciliation schedule. So I kind of want to just add this here because if any new customers have joined us and they're not aware of when we reconcile these non-commodity costs, they can refer to this slide so that they know approximately when they'll start receiving reconciliation. So when we forecast these costs, we always try to forecast as close as possible, but ultimately we will be we reconcile at different periods, and I just wanted to show that with this graph here.
That's great. Thank you very much, Lewis and Alexis. Really appreciated. I think there's some great content there that hopefully everyone found of great use. So what I thought we'd do next is we have a few questions. So again, what I'll do is I'll fire out some of these questions to both Alexis and to Lewis. And yeah, if you guys have got any more or anything subsequently or that you think of after the event, please do share those questions with us. So question one, what are regulators doing about combating lost or stolen gas? It's probably for you, Alexis.
Let me take that away, and I can get back to you on that question.
Okay, let's push on one to Lewis. Lewis, what would cause funds to unwind their positions?
I think the main cause of a fund position unwind would be a couple of things. I think potentially the macro picture changing. So we've had a lot of geo risk over the course of summer. And if that becomes more muted and less prevalent, then that could see funds unwinding their position. Equally, a more kind of certified change in the fundamental picture. So meaning, say we do have a mild winter like we have over the course of the last couple of years, and we do end up having towards that top end of storage being around 50% or even levels we saw last year of 55%, I think that would not only potentially change the view of some of the funds that have that length, but also force those funds to exit their positions after being stopped out if the market drops.
Great, thank you. Alexis, probably another one for you.
Yep.
What would the impact be of regulatory change of the BSUOS be on pricing, stroke the accuracy of pricing?
So like we kind of mentioned within the slides before, due to that high over and under recovery, you'll get more accurate costs reflective of the period that they're active for. So just to give you like a bit of backing context to that, during that first season tariff when they published that tariff at £13 a megawatt hour, there was an over recovery of approximately 300 million, which fed into that next tariff, which is why you saw it drop by almost 50%. So that introduction basically will mean that when these tariffs are now published, because they have a lesser notice period to publish these tariffs, that tariff will be more reflective of the actual cost that National Grid will incur during that period that it's active for.
Okay, thank you. Possibly another one for you. Is there a register that you can access that has all of the CMP updates?
There is, and if you drop me an email with which one specifically you'd like to view, I can attach links and send these across to you.
Great, thank you. Another one back to Lewis. When do you think we'll have a better idea of storage levels for the end of winter?
Good question. I think the 45-day forecast serves as a really good indicator as to storage drawdowns. So I'd say around about mid-Feb, we should have a far better understanding of where storage levels are going to be. But it's also worth caveating that and saying that the 45-day forecast, I think, as I mentioned, does tend to just oscillate around the seasonal normal level. So it can be used as a good indicator as to kind of where we're going to be for the kind of balance of winter once we get into the kind of mid-Feb sort of region, I think.
Okay, cool. Alexis, another one for you. EII businesses that became 100% exempt to capacity market changes charges, from the 1st of October have been paying CM charges since the last reconciliation in March, April. This means that they've been paying 6 months worth of charges towards winter 2024. Will they be reconciled back to zero since they are now exempt from winter 2024 charges?
So exactly that, yes. So when we do the reconciliation in April for capacity market, all EII customers, the amounts that they were paying from April to September that were applicable for this capacity market year will be reconciled. So it will come back to zero, which because of the exemption, the 100% exemption that they are applicable for from October now onwards.
And another one for you, Alexis, actually, is what's your best guess prediction of forecast non-commodity costs for the next 10, 15 years? We might be struggling for the next 12 months, never mind 10, 15 years. But what's your gut feeling?
It's a good question. So I kind of feel like we're getting to a point where non-commodity costs are rising and they're consistently increasing. And that's kind of what I wanted to show in the split in the previous slide. So it's hard to say for the next 10 to 15 year period, but we definitely feel like with the introduction of new levies, with these costs also increasing and also the government trying to achieve the targets that they set, we definitely feel like these costs are becoming more important and will increase quite significantly in the coming years.
Great, thanks, Alexis. So that's all the questions that we've had. If anybody has any further questions subsequent or after this webinar, please do share with your account manager, and we'll deal with those. If I can thank the speakers, and if I can also ask everyone just to take a couple of minutes. We're very keen to run more of these webinars, but would like to ensure is that they're sort of topics that everybody is really keen to have. So if I could ask you all just to take sort of a couple of minutes just to really just look at hopefully the poll that's just been launched.